I need to warn you about something that could truly devastate your financial future. I'm not being dramatic when I say that the Federal Reserve is about to make moves that will punish anyone sitting on significant amounts of cash. If you don't take action before they do, you might regret it for years. What I'm about to share could be the difference between a comfortable retirement and watching your savings evaporate. Now, I'm the last person to tell you that holding cash is always a bad idea. At Berkshire Hathaway, I've been holding record amounts of it, over $300 billion at last count. Cash is wonderful. It gives you options and lets you pounce when opportunities arise. I've built my entire career on having cash available when others were desperate for liquidity. But there's a crucial difference between holding cash strategically and holding it ignorantly. It's the difference between having dry powder ready to deploy and letting your savings sit idle while inflation eats them alive. Right now, millions of Americans are making a catastrophic mistake with their cash. They think they're being safe and conservative, protecting themselves from market volatility, but they're actually guaranteeing that they'll lose purchasing power every single year. Let me explain what's happening and why the Federal Reserve's next moves will accelerate the destruction of cash savings. For the past few years, savers have enjoyed something they hadn't seen in over a decade: high interest rates on savings accounts and money market funds. Parking your money in a high yield savings account and earning 4 or 5% with zero risk felt good and safe. After years of earning essentially nothing on savings, people finally felt like they were being rewarded for their prudence. But here's what most people don't understand. Even at 5% interest, you're losing money in real terms if inflation is running higher than that. And even when inflation comes down to 2 or 3% and the Fed cuts rates back to normal levels, your after-tax return on cash will barely keep pace with inflation. In many cases, it will fall behind. Let me walk you through the mathematics because this is critical. Say you have $100,000 in a savings account earning 5%. That sounds great, $5,000 a year in interest. But now you have to pay taxes on that interest. If you're in the 24% federal tax bracket and you live in a state with income taxes, you might be paying 30% or more on that interest income. So your $5,000 becomes $3,500 after taxes. That's a 3.5% real return. Now, factor in inflation. If inflation is running at 3%, your real purchasing power increase is only 0.5%. Your $100,000 grew to $103,500 in nominal terms, but it only buys you about $500 more in actual goods and services than it did a year ago. You worked all year, deferred consumption, and saved diligently, and your reward is $500 of additional purchasing power. That's pathetic. But here's where things get really dangerous. The Federal Reserve is signaling that they're going to cut interest rates. And when they do, that 5% yield on your savings account is going to disappear. It might drop to 4%, then 3%, then 2%. Suddenly, that barely positive real return becomes a negative real return. And here's what I want you to understand. By the time rate cuts are obvious to everyone, the opportunity to reposition your portfolio will have passed. Asset prices adjust in anticipation of rate cuts, not in response to them. The stock market moves first, then the Fed acts. If you wait until after the Fed cuts rates to get out of cash, you will have missed the move. Let me share some history with you because this pattern has repeated itself many times over my investing career. In 2001, the Federal Reserve started cutting interest rates aggressively in response to the dot-com bust and recession. They cut rates from 6.5% all the way down to 1% over the following years. Investors who were sitting in cash at the start of that cutting cycle saw their yields collapse. Meanwhile, investors who had positioned in stocks and bonds before the cuts captured enormous gains as asset prices rose. The same thing happened in 2008 and 2009. The Fed slashed rates to zero in response to the financial crisis. Savers were devastated. For more than a decade, you earned essentially nothing on cash. Meanwhile, the stock market went on one of the longest bull runs in history. The S&P 500 went from around 600 at the bottom to nearly 5,000 before the next cycle began. Investors who stayed in cash missed out on one of the greatest wealth creation opportunities ever. And it's going to happen again. The Fed will cut rates, cash yields will collapse, and asset prices will rise. The only question is whether you'll be positioned correctly before it happens or whether you'll be left behind. Now, I want to be very clear about what I'm not saying. I'm not saying you should panic and dump all your cash tomorrow. I'm not saying you should take reckless risks with money you can't afford to lose. I'm not saying cash has no place in a portfolio. What I am saying is that you need to understand the trajectory of monetary policy and position your savings accordingly. So, what should you do with your cash before the Fed cuts rates? Let me share my framework for thinking about this. First, you need to understand the difference between strategic cash and idle cash. Strategic cash is money you're holding for a specific purpose. Maybe you're saving. I sometimes think about all the money sitting in savings accounts slowly being eroded by inflation. It's a silent thief, isn't it? Every year the value shrinks and people don't even realize it's happening. That's why I want to talk about idle cash, money sitting with no purpose, often out of fear or uncertainty. It's a problem that needs addressing, especially before the Federal Reserve makes its next move. Now, I know the stock market can be scary. Memories of crashes in 2008, 2000, and during COVID are hard to shake, but consider this. When you buy stocks, you're buying ownership in real businesses. These are businesses that employ people, create products, and generate profits. You own a piece of the productive capacity of the economy. Cash, on the other hand, is just paper. It doesn't create anything. It just sits there losing value. Of course, timing is everything. If you need the money in 6 months, stocks aren't the place for it. But if you're investing for the long term, 10, 20, or 30 years, stocks are overwhelmingly likely to outperform cash. Think about a company like Apple. They have over 1 billion active devices in use, a services business generating over $80 billion a year and more cash than most countries. When you buy Apple stock, you're buying a piece of one of the greatest businesses ever created. The same logic applies to other great businesses like Coca-Cola and American Express. They've survived recessions, rate cycles, and everything the economy throws at them. Owning them is far superior to holding cash. If picking individual stocks feels too risky, there's another option: index funds. When you buy an S&P 500 index fund, you're buying a piece of the 500 largest companies in America. You don't have to pick winners or analyze balance sheets. You just own a diversified portfolio of American business. It's a simple strategy. Put your money to work in the productive capacity of the American economy. Over the past 100 years, the S&P 500 has returned about 10% per year on average. Compare that to cash earning 3%, tax down to 2%, and then losing another 3% to inflation. You're actually losing money every year. The difference between these two paths over 20 or 30 years is life-changing. Consider this. $100,000 compounded at a 2% real return for 30 years becomes about $180,000 in today's purchasing power. But that same $100,000 compounding at a 7% real return becomes over $760,000. The compounding clock is ticking every single day. And every day your money sits idle is a day of lost compounding you can't get back. I've seen too many people make the same mistake, holding on to cash, waiting for the perfect moment to invest. They want to buy at the bottom, but that moment never truly arrives. After investing for over 70 years, I can tell you with certainty that market timing simply doesn't work. Stocks might seem expensive by some me's, and a correction is always possible. But predicting when that correction will happen is a fool's errand. It could be next month or 5 years from now. While you're waiting for the perfect entry point, you're losing precious compounding time. The data is overwhelming on this point. Studies have shown that missing just the 10 best days in the stock market over a 20-year period can cut your returns in half. And those best days often come right after the worst days. If you're sitting in cash, waiting for the bottom, you'll almost certainly miss the recovery. You'll convince yourself you'll get back in at the perfect time, but that time will never come. Dollar cost averaging is the solution. Instead of trying to time the market, just invest a fixed amount every month, regardless of what the market is doing. Sometimes you'll buy high, sometimes you'll buy low. Over time, you'll pay the average price, and you'll be fully invested for the long-term compounding. Now, some of you might be thinking you're too old to invest in stocks. You're retired or close to it, and you can't afford to lose money. But life expectancy keeps increasing. If you retire at 65, you might have 30 more years of life ahead of you. That's a long time. You can't spend 30 years in cash, losing purchasing power to inflation. You need some expo to assets that grow faster than inflation. I'm not saying retirees should put everything in stocks. A balanced approach makes sense as you age. But zero stocks and all cash is a recipe for running out of money. You need growth assets to maintain your purchasing power over a multi-decade retirement. Others might be thinking about liquidity, wanting the security of knowing your money is available at any moment. But most of you don't need as much liquidity as you think. Yes, you should have an emergency fund. 3 to 6 months of expenses in cash is reasonable. But beyond that, what are you keeping liquid for? Most expenses are predictable. Most emergencies can be handled with a credit card while you liquidate investments. The security blanket of excess cash is costing you a fortune in lost returns. Let me share one more concept that I think is critical for understanding this moment: opportunity cost. Every financial decision involves opportunity cost. When you choose to hold cash, you are choosing not to own stocks. When you choose to own stocks, you are choosing not to hold cash. These choices have consequences that compound over time. Right now, millions of people are paying an enormous opportunity cost by holding excess cash. They feel safe, they see the dollars in their account, and they feel secure, but they're not seeing what they're giving up. They're not seeing the compounding they're missing. They're not seeing the wealth that's slipping through their fingers. The Federal Reserve is about to make this opportunity cost even more painful. When they cut rates, cash yields will drop, but stock prices will likely rise as lower rates make future earnings more valuable. The gap between cash returns and stock returns is going to widen. The opportunity cost of holding cash is going to increase. This is why I'm saying to act now. Get out of idle cash before the Fed makes its move. Put your money to work in productive assets. Buy quality stocks or low-cost index funds. Start the compounding clock. Give yourself the best chance of building real wealth over time. I want to be absolutely clear about one thing. I am not telling you to be reckless. I am not telling you to bet money you cannot afford to lose. I am not telling you to ignore your risk tolerance or your time horizon. Everyone's situation is different. Everyone needs to make their own decisions. What I'm telling you is to think clearly about the real risks you face. The risk of the stock market going down is real, but temporary. Markets recover. They always have. The risk of inflation destroying your purchasing power is also real, and it is permanent. Money lost to inflation never comes back over long time periods. The inflation risk is far more dangerous than the market risk. I have watched inflation destroy wealth my entire life. I watched it in the 1970s when inflation ran above 10% for years. I watched it in the 2000s when low inflation and low interest rates quietly eroded cash savings. I am watching it now as people sit in cash thinking they are safe while their purchasing power slowly disappears. Do not let this happen to you. Do not let the Federal Reserve's policies destroy your savings. Take action while you still have time. Get out of idle cash and put your money to work. Let me leave you with this thought. 50 years from now, your grandchildren are going to look at the financial decisions you made in your lifetime. They are going to see what you did with your savings. They are going to understand whether you built wealth or let it slip away. What story do you want them to tell? Do you want them to say that you understood how money works, that you invested wisely, that you built a foundation for generations of prosperity? Or do you want them to say that you were scared, that you hid your money under the mattress, that you let inflation eat your savings while you worried about short-term volatility? The choice is yours, but the clock is ticking. The Fed is going to cut rates, cash yields are going to collapse, asset prices are going to move. The question is whether you will be positioned correctly or whether you will be left behind. I know what I am doing with my money. I am owning productive businesses. I am owning assets that will grow faster than inflation. I've been putting my capital to work for over 70 years, creating wealth instead of letting it sit idle. It's made me one of the wealthiest people on earth, not because I'm smarter or have special information, but because I understand a simple truth. Cash is a terrible long-term investment. Productive businesses, on the other hand, are wonderful. The choice between them isn't even close. Now, I want to talk about the specific mechanics of transitioning from cash to investments, because knowing what to do is only half the battle. You also need to know how to do it. The first step is to audit your current cash holdings. Most people have no idea how much they actually have. Checking accounts, savings accounts, money market funds, CDs, add it all up. Figure out exactly how much cash you're sitting on. Then categorize that cash. How much do you need for emergencies? How much for near-term planned expenses? How much is truly idle with no specific purpose? Be honest with yourself. Most people overestimate how much liquidity they need. Create a plan to deploy it. I wouldn't recommend moving everything into stocks at once. That creates too much timing risk. Instead, set up a systematic investment plan. Move a fixed amount into investments every month over the next 6 to 12 months. This way, you're dollar cost averaging your entry rather than making one big bet on today's prices. Choose your investments carefully. If you're not comfortable picking individual stocks, use low-cost index funds. The S&P 500 is a great choice for most people, giving you expo to the largest and most successful companies in America with minimal fees and minimal effort. If you want to own individual stocks, focus on quality. Look for companies with strong competitive advantages, consistent profitability, manageable debt levels, and honest, capable management. These are the businesses that will compound your wealth over decades. Don't chase hot stocks or speculative ideas. Don't try to find the next big winner. Don't buy things you don't understand. Boring is beautiful when it comes to investing. You want businesses that will still be thriving 20 years from now, not businesses that might be disrupted next year. Set up automatic investments so you don't have to think about it. Human psychology works against us when it comes to investing. We want to wait for the perfect moment, buy low and sell high, but these instincts lead us astray. Automation removes emotion from the equation. Set up automatic transfers from your checking account to your investment account and automatic purchases of your chosen investments. Then forget about it and let the system work. Review your portfolio periodically, but not obsessively. Once a quarter is plenty for most people. Make your allocation still make sense. Rebalance if things have drifted too far from your targets. But don't tinker constantly. Don't react to every piece of news. Don't let short-term volatility shake you out of your long-term plan. The most important thing is to start today, not next week, not next month, not when the market feels safer. Every day you delay is a day of lost compounding. The Fed is going to cut rates whether you're ready or not. Position yourself now while you still have time. I've been investing for over 70 years. I've seen bull markets and bear markets. I've seen interest rates at 20% and at zero. I've seen inflation high and low. Through it all, one thing has remained constant. Owning quality businesses beats holding cash over the long term. It's not even close. It's one of the most reliable patterns in all of finance. Take advantage of this knowledge. Get out of cash before the Fed cuts rates. Put your money to work in productive assets. Give yourself the best chance of building real wealth. Your future self will thank you. Let me tell you a story that illustrates exactly why this matters so much. Back in the early 1980s, interest rates were at historic highs. The Federal Reserve under Paul Volcker had raised rates to nearly 20% to break the back of inflation. If you had money in a savings account, you were earning 15 or 16%. It felt incredible. You were getting rich just by doing nothing. But here's what most people missed. Those high rates were temporary, a response to a specific crisis. Once inflation was under control, rates were going to come down. And when they did, the people who had gotten comfortable with those high cash yields were in for a rude awakening. Some smart investors understood this. They recognized that when rates eventually fell, bond prices would soar and stock prices would likely rise as well. So instead of sitting in cash enjoying the high yields, they bought long-term bonds and quality stocks. When rates did fall through the 1980s and 1990s, those investors made fortunes. The people who stayed in cash saw their yields drop from 15% to 10% to 5% to eventually almost nothing. We're at a similar inflection point right now. Cash yields are elevated because the Fed raised rates to fight inflation, but those elevated yields aren't permanent. They're a response to a specific situation. When the Fed decides that inflation is under control, when they decide the economy needs stimulation, rates are going to come down, and the people sitting in cash are going to watch their yields evaporate, just like they did in the 80s and 90s. The difference between those who build wealth and those who watch it slip away often comes down to these inflection points. The people who recognize the turn in position accordingly end up driving. I've seen wealthy people drive themselves crazy with cash, millions sitting in bank accounts, earning next to nothing as they obsess over finding the perfect entry point for stocks. Years can go by, bull markets are missed, dividends are missed, compounding is missed, all because they couldn't pull the trigger. It's a strange kind of paralysis. Let me tell you something most financial advisors don't discuss: the psychological damage of holding too much cash. When you hold large amounts, you're constantly watching for the right moment to invest, constantly second guessing yourself. Every market dip looks like the start of a crash. Every rally makes you feel like you missed the boat. It's exhausting. Getting invested solves this problem. Once your money is working in quality businesses, you stop obsessing about timing. You stop watching every tick of the market and start thinking like an owner rather than a speculator. This mental shift is incredibly liberating. I own stocks and companies. I never think about selling. I own pieces of wonderful businesses like Coca-Cola, American Express, and Apple, and I don't care what the stock price does on any given day. Those businesses will keep generating profits whether the stock market goes up or down. My job is just to own them and let time work its magic. Before I close, I want to address one more common objection. Some people tell me they're holding cash because they want to buy real estate, saving for a down payment on a house or an investment property. Real estate requires large amounts of cash for down payments and closing costs, so they keep accumulating cash in a savings account. Here's my response. First, be realistic about your timeline. If you're going to buy a house in the next year or two, then yes, that money should probably stay in cash. But if your real estate purchase is 3, 5, or 10 years away, you're making a mistake by holding cash that whole time. You're losing years of compounding. Second, consider whether real estate is really the best use of your capital. It can be a fine investment, but it's not magic. It requires work to manage and capital to maintain. It's illiquid. You can't sell a bedroom when you need cash. In many cases, you'd be better off investing in publicly traded businesses and using the proceeds for real estate when you're actually ready. Third, remember that you can access home equity through mortgages. You don't need to pay cash for a house. In fact, given that mortgage rates are often lower than the returns available from stocks, it can make sense to put down the minimum and invest the rest. And this is a more sophisticated approach, but it's worth considering. The key point is that holding cash for years while waiting to buy real estate has a significant opportunity cost. Make your accounting for that cost in your planning. Let me summarize. The Federal Reserve is going to cut interest rates. This isn't speculation. It's how monetary policy works. When they cut rates, cash yields will fall dramatically. The 5% you're earning today could become 3%, 2%, or eventually almost nothing. At the same time, inflation will continue eroding the purchasing power of your cash. Even at low rates of 2% or 3%, you're losing ground every year after taxes and inflation. Cash is almost always a losing investment over the long term. The solution is to get your idle cash working in productive assets before the Fed makes its move. Buy quality stocks, buy low-cost index funds, own pieces of real businesses that generate real profits. Let compound interest work for you instead of against you. Don't wait for the perfect moment. Don't try to time the market. Don't let fear of short-term volatility keep you from building long-term wealth. Start today. Set up automatic investments. Be patient. Be disciplined. Be consistent. The next decade will separate the wealth builders from the wealth losers, the people who understand monetary policy, who understand inflation, who understand the power of owning productive businesses. They're going to thrive. The people who sit in cash thinking they're safe will watch their purchasing power slowly evaporate. I've seen this movie before. I've seen it play out after every interest rate cycle. The ending is always the same. Savers get punished. Investors get rewarded. The only question is which group you're going to be in. I know which group I'm in. I've been investing in productive businesses for over 70 years. I've never regretted owning quality companies. I have often regretted holding too much cash. Learn from my experience. Get out of cash before the Fed cuts rates. Your financial future is at stake. The time to act is now.